Now, when it comes to investing in the UK, who doesn't want a slice of the American markets, in particular the S&P 500? Now, in front of me on Trading 212, you can see this is the Vanguard S&P 500, the VUSA, one of the most common S&P 500 funds for UK-based investors. The first thing you may notice is that the price is in pounds and pence. Now, this means in the UK, there are no extra foreign exchange fees that you're going to have to pay in order to buy into the S&P 500. So this is really good. You can see that over the past month, the return has been 9.21%, which is pretty good. Over the past year, the return has been 4.55%, which is pretty good again. Now on Trading 212, if you scroll down, you can find out more about the S&P 500. Now, things to note about choosing an index fund of your choice is, first of all, the expense ratio. So as you can see here, the expense ratio is 0.07%. Typically, anything below 0.3% is pretty good because the expense ratio, sometimes known as the TER or the total expense ratio, sometimes even known as the OCF or the ongoing charges, this is how much your fund costs per year for the fund manager. You don't actually have to pay these fees. These fees come out of the value of the fund. Now, 0.07% is really cheap. However, if you look at the Vanguard S&P 500 funds in the USA, they are actually cheaper. However, one thing that you have to realize is that the fund manager, which is Vanguard in this case, has to, deal with foreign exchange. So there has to be a lot of buying in pounds, converting into dollars, and then on the way back, dollars converting into pounds. Now, this is not something that you have to worry about as the end buyer in the S&P 500 when you're investing with someone like Vanguard. So it's really nice to see. You can just buy in pounds and you can sell in pounds too. There's also stuff like the assets under management. So essentially, the bigger the fund size is, more people's money is at stake, so it's less likely to fail, although that doesn't always, go as planned. £33 billion into the VUSA here. Amazing. There's also dividend yield and frequency. That's all well and good. But you can see the asset allocation for most funds that are tracking the S&P 500, at least in the normal way, is going to be about Apple 7%, Microsoft around 5 or 6%, Nvidia around 5 or 6%, Amazon around 4%, Meta around 2%, and the list goes on. You can also see the sectors that this fund exposes you to, for example, technology, financials, healthcare. It's all very standard in the way that you should track the S&P 500. However, as a UK investor, there are many options when investing into the S&P 500. Here is one that I specifically invest into. It is called the iShares Core S&P 500, in particular the GSPX. Now, you can see over the past month, the return has been significantly higher at 13.58%. And over the past year, the return has again been significantly higher compared to the VUSA at 10.37%. So in this video, I'm going to be exploring why there is such a big difference between these two funds and if you are making the right choice when it comes to S&P 500 funds as a UK investor. Now, if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the section Use Promo Code. And in this section, just use my code JUBAIR and you should receive a free fractional share. So going back to the GSPX, as you can see, I told you that over the past year, the return has been 10.37%, significantly, in fact, more than double the return of the Vanguard USA. Now, as an investor into the Vanguard USA or the VUSA, you may be very upset, maybe I made the wrong choice. However, I'm going to show you what the differences are. Then you might be more comforted or maybe thinking you have made the wrong choice. Now, I have invested hard into this fund. As you can see, I own 11,180 shares, which is down still by a huge amount, 6.05%, or a loss of £6,854. Now, compared to the VUSA or the Vanguard S&P 500, as you can see, they're both distributing funds. Now, distributing just means that the dividends are paid out to the shareholder instead of being reaccumulated back into the fund. So it's a good comparison here. For what it is worth, the GSPX does pay a slightly lower dividend yield, and the dividend frequency is less frequent at twice a year instead of every quarter, which is 4 times a year. Now, the first difference that you will see is that the expense ratio is actually higher at 0.1%. Now, compared to 0.07%, this is a 30% increase in the total expense ratio. Now, 30% sounds like a really big deal. However, when you're comparing 0.07% versus 0.10%. Personally, I don't think that's a huge amount because you're comparing two very small numbers. However, if the expense ratio was something like 1%, then that would be a lot more expensive. Now you can see assets under management is huge, much larger than the Vanguard USA. I should really say VUSA, but the assets under management are 111 billion pounds or 0.1 trillion pounds. I wouldn't pay too much mind to the dividend yield or frequency actually. Now when it comes to actually tracking the S&P 500, you're getting a very similar deal here with Apple around 7%, Microsoft around 6.5%, Nvidia around 5.74%. For those of you with eagle eyes, you will notice that the allocation is slightly different when comparing to the VUSA. However, overall, you're pretty much getting the same funds. If you go under sector, you can see that you're pretty much getting, the same exposure. Okay, so we have compared the two, and the only difference that we can see on paper, on Trading 212 anyway, is that the GSPX has given a much better return over the past year and over the past month, and it's only 30% more expensive. So what is the catch? Why invest into the GSPX? Why has that given a higher return? Now, remember in the beginning when I told you that the fund manager deals with the S&P 500 tracking, with pounds, they buy into these companies. For example, Apple, Microsoft, Nvidia, Amazon, all of those companies, they take your pounds, they invest into that. However, when it goes from pounds into dollars, there is a foreign exchange. And now, of course, the more funds you have, the better the deal you get with foreign exchange. So by bunching everyone's money together, the economies of scale of foreign exchange become a lot more favorable towards the fund provider. However, you still have to convert between pounds and dollars. So with the case with the VUSA, Vanguard has to, take your money in pounds, buy the companies, for example, Apple, Nvidia, Microsoft, let's say. And when that happens, pound is being converted into dollars. That costs a bit, but it's fine. However, the big problem is when it goes back from dollars to pounds, there is a secondary foreign exchange. Now let's have a look at this very important graph. This shows how much £1 gets in terms of dollars. You can see at the beginning of 2025, £1 would have got you only $1.22. Today, it buys you $1.33. Now, this means that the pound has been in recent times strengthening against the dollar. Now, think back to our example of the Vanguard S&P 500. Vanguard buys in pounds into dollars. However, getting back from dollars to pounds, if the pound strengthens, that means you get back less of a return on your investment. So essentially, Vanguard and iShares are tracking the exact same market. However, when foreign exchange is considered, the pound is just strengthening against the dollar, which means that your Vanguard USA or the VUSA returns are considerably lower. If the pound continues to strengthen against the dollar, those investments that you made in the past are going to be worth less for you as a UK investor who deals with pounds and pence. So conversely, the GSPX is a currency hedged ETF, which means the fluctuation between the pound and the dollar, they are more stabilized. This uses very complex financial instruments, and overall, this is not the most perfect way of hedging. And compared to not hedging, hedging actually imposes certain risks with the financial markets. If they go haywire, you can actually potentially lose money. With the VUSA, there is no hedging, so that risk is alleviated. However, because the currency is hedged, the amount that for example, the GSPX goes up and down by is way more similar to what you see with the S&P 500 index. Now, when I say more similar to the S&P 500 index, I mean this here, the original index, which is just in points. Now you can see over the past year, the index, the original S&P 500 index is up by 8.4%. Now I'm not saying this time axis matches exactly with Trading 212. However, we can see it is significantly higher than the return on the Vanguard USA. So now that we understand the differences, the biggest difference here is currency hedging. And although over this time period, currency hedging has given us a better return, over the long term, there is no guarantee that the currency hedging will give us a competitive advantage when investing into the S&P 500. For example, if the pound depreciates compared to the dollar and you have invested a whole bunch, then by hedging, you would actually miss out on a lot of gains on your investment because the investments into the S&P 500 that you bought in the past, if the pound then subsequently depreciates compared to the dollar a lot, then in the future, your investments in terms of pounds and pence are going to be worth a whole lot more. So make sure to check out some of my other videos and I'll see you in the next video.